Hi, everyone. So, good evening and welcome to this fireside chat discussion this evening on financial reporting, corporate reporting. Tomorrow morning, financial reporting 9 a.m., corporate reporting 2 p.m. as we go into the November 2025 examination. And it is going to be a time where we walk through a couple of things that we need to understand and then also take the moment to answer any questions that we may be having specifically and address challenges that students will be having and help you to put you in the position to go into the exam hall and pass the examination. So it's going to be a back and forth discussion where we're going to be walking through a couple of things. I'm going to try to also draw your attention to some few things that you need to be mindful of as you walk into the exam hall tomorrow. But the most important thing is on the overall, we want to just spend some time and then look at some of those key issues and then also address any challenges that we may be having as we walk into the exam hall tomorrow morning as well as tomorrow afternoon based on the subjects that we are writing respectively. So before I go through anything or before anything else, if there are any questions that you have for me, something specific, all right, something specific that you want to ask, you can put it in the chat for me, or those of you on Teams with me, you can raise your hand. I bring you up. So if there is something specific that you want to pick my mind on, you can put it in the chat for me, or you raise your hand. I bring you up, and then you can ask your questions. I'll provide you with some answers. Again, something specific to help us walk in through the discussion today at the end of the day. Now, when it comes to dealing with the issue in respect of financial reporting and corporate reporting, we've shared our thoughts on the various things over the last 12 weeks. I mean, having the opportunity to walk through about 98% ish of the syllabus, upward of that, making sure that you go into the exam more well prepared generally. But then the question we need to ask ourselves is, at this moment, at this point, are you prepared? Are you ready generally at the end of the day? Do you have the capacity to walk into the exam hall tomorrow and replicate everything that has been done, everything that has been discussed? Most importantly, apply the principles based on the context of the question. That's going to be something that you are going to be dealing with tomorrow as you head into the examination. So let me bring up my screen quickly and we're going to be getting into the discussion. Now, a few things before I get into my slide. We mentioned that when it comes to dealing with the financial reporting and corporate reporting examination, one thing we must understand is that we would have to be mindful of the fact that we'll have a theory question coming in. For financial reporting students, your theory questions will be in question 5. And we have mentioned the various theory areas that the examiner may get excited on: sustainability issues, ethics issues, governance issues, integrated reporting issues, theories on consolidated financial statement, and all of those areas, theory areas waiting for you in the exam or in question 5 that you must understand. For corporate reporting students, we have highlighted significantly that the theories are going to be spreading across. Question 3B will have a theory in there. Question 4B will have a theory in there. Then we'll have the rest of the theories coming in the question 5. And so for corporate reporting, the theories will be spreading across for the minimum of 20 marks theory question that we need to understand. We also highlighted that it depends on the context of the exam, or it depends on how excited the examiner is going to be as you go into the exam. But the question 2 area, which is going to be accounting standard dedicated issue, the examiner can ask you some theory issues even there in the accounting standard area, question 2, that you must be mindful of. So not only are you going to be doing calculations and things here in the question 2 area, the examiner can come in for some theory questions relating to maybe a disclosure requirement or discussing an action that management has taken or a decision that management has taken in respect of how they have treated something in the financial statement. Then you as the professional will be coming in to explain the principles underlining that particular transaction and either agree with what management has done or disagree with what they have done, and so then make the right recommendation at the end of the day. So the question 2 area, pretty important that we need to understand. Then the third thing that we highlighted that you need to be mindful of will be the issue about the verbs that the examiner is going to be using. So the examiner can just say, oh, explain how the above transaction will be treated in the financial statement. Describe or recommend or discuss how the above transaction will be recognized in the financial statement. Now, if the examiner puts you in that position, especially for corporate reporting students, these are the verbs that the examiner is going to be getting excited about. Whether I like it or not, you're going to be seeing some skirmishes on describe, recommend, discuss, explain. Yes, it's an accounting standard question, but the examiner is taking you on the journey to speak English. And so, as we have mentioned, and I just want to remind you of that quickly, you have to be mindful not to leave marks on the table. Why is this important? Because we don't know the specific marking scheme and mark allocation that the examiner is going to be electing. So if the question says, oh, describe how the above transaction will be accounted for in the financial statement, and then all you do is you do your calculation and walk away, guess what? You are going to be walking away with some theory the written parts, the marks, which you are not going to get. So you have to be careful so you are not leaving marks on the table. And this is very important because some of you, because of the issue in respect of lack of grammar, lack of comprehension, and the fact that you lack the ability to comprehend a lot of the issues when it is supposed to be written, then the examiner is going to be getting you on that angle. So you have to be on the lookout, and we've emphasized on this over and over again. Over the period, we've been solving questions where I write out the standard, the way you are supposed to position yourself and write out the theories in respect of the question. So please be mindful and be careful that you write the answers to cover each aspect of the questions. There are some questions the examiner may ask you, okay, explain how this should be treated in the financial statement. Easy peasy, right? So you're going to explain as per the accounting standard, Then you do the calculation. You may pass a double entry, or if you want, you can extract financial statements. That's at your own discretion. That is not an issue in respect of that. Sometimes the examiner can just say, explain how this will be treated in the financial statement, and extract the financial statement. So it means that you're going to be writing the English, do the workings, and then number 3, you're going to be extracting the financial statement as well. So please, it is important you read the question, understand the context of the question, and write out your answers to ensure that it is covering all aspects of the questions. If not, let's say we have 6 accounting standards spread across for 30 marks, corporate reporting students, question 2 and question 3A. And half of that is explained, and explain how the treatment is supposed to be, or the accounting information or transaction should be treated in the financial statement, and you didn't write the English, you just do the calculation, it means you are losing significant portion of the marks there. And that is where sometimes people would then say, oh, I answered all the questions. No, mom, you didn't answer all the questions. You answered what you thought you could do. And so please be mindful of the structuring of the question, because you don't want to leave marks on the table. The examiner is not going to be using your marks for anything. So there's no need to try to give the examiner the opportunity to have that at the end of the day. So these are some few things I want to draw your attention on as we get ourselves prepared to go into the exam hall tomorrow morning as well as tomorrow afternoon for financial reporting and corporate reporting respectively. So let me bring up my screen quickly, then we can walk through a few things that I can share my thoughts on briefly, and then we will be out of here. Again, let me also say this. The strategy is to answer the theory questions first, as we discussed. Number 2, you go to evaluation of financial statement. Is easy. You could pick it up. Then financial reporting students, between question 2 and then the single entity financial statement, they are going to be standards application anyways. So you choose the one that you want to answer first in that regard. Then you come to the last but one question, which is going to be consolidated financial statement. So that is the plan that we have mentioned in that regard. Corporate reporting students, you take out all the theories, but remember your theories are going to be spreading across board, right? Question 3B, question 4B, and then question 5, right? We may even have a theory in question 1, depending on the objective of the examiner. So you want to find out where the examiner has embedded the theories, but at least we are promised of 20 marks theory as well there. So you take out the theories, then you come to the evaluation of the financial statement, then you go to the specialized transactions, whatever that is going to be there, financial reconstruction, corporate reorganization. From there, you can kick the standards, some of them, or between standards and specialized transaction, as I mentioned, you can choose whichever. So by the time you are coming to consolidated financial statement, you're in a comfortable lead and there are no problems that you need to really be worried about. So these are some mechanics that you have to be mindful of as you go into the exam. And this is to make sure that you work with speed and accuracy, you save time, because you are not going to be able to answer all the questions. That's the reality of the thing. But you need to be able to structure yourself in such a manner that you do upward of 4 marks or 4 of the questions. So you answer 4 questions, maybe on the last one, doing some workings for that, which will be consolidated financial statement, all other things being equal. Stop work. You're going to be in a comfortable lead if, again, you follow the blueprint in respect of what you have been told to do when it comes to the preparation of the financial statements, application of the standards, evaluation of financial statements, and the exam as a whole. So let's come in here and then look at some few things. And I'm coming in from the revision notes that we prepared and shared with you. I'm coming in from there, and I'm going to be jumping in between that and my slide to bring some ideas across board in the few minutes that we have. Then we can say goodbye for the day. And so when it comes to the corporate reporting or financial reporting examination, we said our pass depends on mastery of the accounting standards. Why? Because on the average, about 70% of the content we must call on the accounting standards. So it's going to be crucial. And so at this point, all other things being equal, it means that you're in a comfortable lead, all other things being equal when it comes to the accounting standards. But that is going to be taking a center stage. Consolidated financial statement, single entity financial statement, interpretation of the financial statement, and then the theory areas that we must understand when it comes to the examination. But let's go to those standard issues, because 70% is a significant area. So I'm going to try to see if we can walk through a number of the standards, crystallize some of the principles, draw some attention quickly to some of the issues there that we need to be mindful of. So we come to the accounting standards. Financial reporting students, we said whether you like it or not, IAS 16, IAS 12, you must understand everything there. Whether you like it or not, it's waiting for you in the exam hall. That's a done deal area. Corporate reporting students, you have no excuse for these guys. And so if you remember when we started our discussion, we spoke about the fact that when it comes to the accounting standards, IAS 16, every accounting standard you pick, we have key definitions, we have objectives of the standard, we have initial or recognition criteria, we have initial measurement and recognition, then we have subsequent measurement, then we have disclosure requirement. Please note, the examiner can ask you questions from any of the areas in respect of the recognition criteria. So we could be asked questions on the recognition criteria, the initial measurement and subsequent measurement. Okay, the initial measurement and recognition, the subsequent measurement issue, and certainly disclosure requirements. And so every accounting standards we pick, the recognition criteria, if it is available, what is it? Initial measurement, how do we go about that? Subsequent measurements, how do we go about that? How or what about this standard do we have to disclose in the notes to the financial statement? Because the examiner can come from you from these four categories or these four areas when it comes to dealing with the accounting standards. And that is why I keep on telling you, it's not just about, yes, I am able to do the calculation, but also it's about understanding the principles so you can apply the principles well at the end of the day. And so we started our journey with IAS 16, property, plant, and equipment. And we said when it comes to the initial measurement of property, plant, and equipment, there are a number of standards that may come to town there, like IAS 37, provisions, like IAS 20, government grants, like IAS 23, borrowing costs, IAS 19, employee benefit. On subsequent measurement, some accounting standards will also come to town, IAS 36, IAS 12, IAS 40, IAS 2, and IFRS 5. All of these are standards that are connected with IAS 16. And so we made mention of the fact that, all right, how do these standards really come together? So for starters, we said if an entity controls an asset, okay, an entity controls an asset, and the entity is using that asset for the day-to-day running of the organization, then certainly that asset is an owner-occupied asset. If the asset is an owner-occupied, the entity is using the asset in the day-to-day running of the organization, then we apply IAS 16, property, plant, and equipment. However, where the entity controls the asset and has rented it or leased it out under an operating lease, or is undecided what to use the asset for, or is holding on the asset for capital appreciation, then that is a non-owner occupied non-current asset, IAS 40, investment property. Then we spoke about IFRS 5, non-current asset held for sale and discontinued operation. So this is where an asset that the entity is using for the day-to-day running of the organization, the entity for some reason says they are not going to use it any longer. But we spoke about the recognition criteria for IFRS 5, non-current asset held for sale and discontinued operation. We said management must have decided to sell the asset. That is the S. Number two, the asset must be available for sale. What does that mean? It means if management has made a decision, but they are still using the asset, then we cannot recognize the asset as a non-current asset held for sale or discontinued operation. Then we said, hey, management is looking for buyers or has even located buyers, and they are in the process of negotiating the price and the sales, and they expect the sales to be completed within 12 months. So these were the tone we set up in the discussion when it comes to the accounting standards. Why are these three important? Because of the next play. For instance, we mentioned that an entity is using the asset for the day-to-day running of the organization. Then they said, we have decided to sell it. The asset is available for sale. We have located a buyer, or we've advertised, and we expect the sale to be concluded in less than 12 months. Okay, or within 12 months. So what is the accounting treatment of that? The rule we established was that at the date of the change of use, what do? We calculate the carried amount of the asset. Then we determine the net realizable value of the asset. Why? Because the initial recognition of non-current asset held for sale or discontinued operation shall be the lower of the carrying amount and the net realizable value. The lower of the two. So what does that mean? It means that if the realizable amount is above the carrying amount, the asset is carried at the carrying amount. So the non-current asset held for sale is carried at the carrying amount. However, where the carrying amount is greater than the net present value, net realizable value, it means we carry the asset at the lower, which is the net realizable value. In that case, the asset has suffered an impairment. And so that impairment will go to P&L account. You remember during our mock discussions, we solved a question like that, and you saw the way the workflow was. Because these are the nuances that you must understand. The broader standard issues, you could apply them. You may understand them, but the nuances comes in when we are moving in between the standards and the other issues are coming in that you have to be mindful of. And that's the thing there that you must understand. Then on subsequent measurement, you don't depreciate non-current asset held for sale again, right? But they are going to be remeasured and carried at the net realizable value. So any subsequent impairment in the non-current asset held for sale will again be written off in the profit or loss account. And these are the things that we mention about the movement between IAS 16 and then IFRS 5 in that case. But we didn't end there, because we also spoke about issues in respect of IAS 40, investment property. As I mentioned earlier, either we are holding on the asset for capital appreciation, or we are undecided, or we have leased it out or rented it out under an operating lease. In that case, we apply IAS 40. Please note, the default principle for dealing with IAS 40 investment property is to carry it at fair value, so that any fair value gain or loss is recognized in the P&L account. However, remember, if we cannot determine reliably the fair value of the asset, then the investment property shall be carried at its historical cost, less accumulated depreciation or impairment losses. What does that mean? It means there are cases where if we cannot reliably estimate the fair value of the investment property, in that circumstance, we will carry the investment property at its historical cost, then we less any depreciation that has to be less. That is the idea in respect of that, and that is what we must understand when it comes to investment property. IAS 40. That's all. On the nuance aspect, we can move from investment property to IAS 16. We can move from IAS 16 to investment property. So those will be the nuances. So in that nuances, what do? So for instance, let's say that we move from investment property to IAS 16. Okay, meaning we are moving from a non-owner occupied non-current asset to an owner-occupied non-current asset. What do we do in that particular case? Simple. You know, investment properties are carried at what? Fair value. So at the date of change, we determine or estimate the fair value of the investment property. And that fair value becomes the initial measurement of the property, plant, and equipment. Then from the date of change to the year ended, we need to now start to calculate what? Depreciation. You see, that is very easy, right? That's the idea. So when we move from IP to PPE, that's the flow. Okay, so what if we move from PPE, IAS 16 to IAS 40? Okay. Remember, at the date of change, what is going to be happening is that we determine the carrying amount of the asset. Then we determine the fair value of the asset as well, because it's an investment property now. And this is the plot twist. If it happens that the fair value is greater than the carrying amount, you know investment property must be carried at what? The fair value in that case. So if the fair value is greater than the carrying amount, that is a revaluation surplus. Okay? It's a revaluation surplus and it goes to OCI, as you know already. However, if the fair value is less than the carrying value, you know the rule, right? That's an impairment. So it means the asset has suffered an impairment, and that is going to be put in the P&L account. But here is the twist. On subsequent measurement of investment property, what we gonna do? We carry it at fair value, so that any fair value gain or loss will be taken into the P&L account. Now, here is the nuance. So let's say that the fair value of the asset was, say, 10,000, right? Let's say 10,000. Then the carrying value was 7,800. So it means at the initial recognition stage, we are recognizing a surplus of 2,200. And that's going to go to revaluation what? Surplus. Right? Then on subsequent measurement, we are carrying the investment property at fair value. Then now the value of the investment property has fallen to whatever. Let's say 8,400. You got to be careful, because we said on subsequent measurement, fair value gain or loss on the investment property must go to P&L account. But remember, in my illustration here, when you did the change, you had a surplus. So any All right, so let's continue. I think my network jammed over a little bit, so I think I should be back now with my flow. All right, let's go back into my discussion. We good? Yeah, we good. Okay, so I was talking about the movement with IAS 16 and to IAS 40, right? So that is the idea in respect of that. So when we are moving from IAS 16 to IAS 40, we must understand the rules there to know how to apply the rules at the end of the day in respect of that. Then, so those are the rules that I have already spoken about with you when it comes to those few key issues. And then from IAS 40 to PPE to how we go with the flow in that case. Then one fundamental accounting standard that we mentioned will be primary when it comes to dealing with financial reporting and corporate reporting is this standard, IFRS 13, fair value measurement. It's an accounting standard. If you remember, we said it's going to be running through a lot, because fair determination of fair value of an asset or liability is a fundamental thing that will come, that we must apply the rules or the principles based on the context of the question. And so IFRS 13, very important. Now, we said that when it comes to IFRS 13, how do we determine the fair value of an asset or a liability? 3 levels. So level 1 is where there is an active market. So if there is an active market for that asset in question, okay, then the quoted price in the market becomes the value at which the asset will be sold for the period under review. Very simple, very easy, straightforward. We apply the rule. But then we said sometimes there is no active market. And so when there is no active market, then we can go to the next level, which is to look for any most advantageous market. In other words, the issue here is that the entity may be selling its product in more than one market. And so in that case, even if there is an active market, the entity may be selling its product in more than one market. And so if you remember, we spoke about the principle of, we spoke about the rules in respect of the principal market and the most advantageous market. So for instance, we mentioned that where there is no active market directly available, or the principal market cannot be easily determined, then we're going to be using the most advantageous market. The most advantageous market is the market within which the entity sells, within which there is more volume of activities. Remember, it is not the market within which the entity sells more of its product. So if an entity is selling its product in Kumasi, the whole industry, it's in Kumasi, it's in Accra, it's in Takoradi. Okay, so these are all the markets. So which of these 3 markets will become the market whose fair value will be used to determine the value of our assets for the period under review? We look at the market with the highest volume of activity, and that becomes the most advantageous market. So if you remember, we solved a question in respect of determination or using the principal market and the most advantageous market to determine the value of the closing inventory of an entity in respect of that. But in addition to that, sometimes there is no market available, meaning we cannot determine principal market, we cannot determine most advantageous market. Then certainly we will go with the level 2, which is to use the transaction of similar assets. So assets in a similar group, how much are they selling for? That becomes the guiding rule. If that is also not possible, then we can use information about the asset, and it will depend on the context of the question. So for instance, we say that, oh, we have an asset right now, and the asset has a carrying amount of, say, $10,000, right? But then the assets can be redeveloped. If it is redeveloped, the fair value of the asset is going to be $25,000, right? After redevelopment. Now, the cost the entity will incur to redevelop, it's say maybe 7,000. So what does that mean? The carrying amount of the asset now is 10,000, but it can be redeveloped. Maybe it's a building, it's a land or something. If it is redeveloped, the fair value will be 25,000. The cost to redevelop is 7,000. So it means the fair value of this property will be the value of the redevelopment after the cost of redevelopment. So it will be the value of the asset after the redevelopment minus the cost of the redevelopment. So in my scenario here, it means my fair value is going to be the 25,000 minus 7,000, and certainly that is going to be giving us 18,000 there. And as you can see, the fair value of the asset exceeds the carrying amount of the asset. And so definitely the difference is going to be treated as revaluation surplus for the period under review. So that is the rule about the IFRS 13. So the examiner may present us with a scenario, with a question, where we have to estimate the fair value of the asset. But rule number 1 cannot apply, or level 1 cannot apply because we don't have any active market. So we cannot determine principal market, most advantageous market. Rule number 2 cannot apply because there are no similar assets whose value we can use in determining the value of the asset in respect of that. Then in that case, we come to rule number 3. And the examiner will give you the information. And you have to pay attention to read it. They will say that, oh, if this asset is redeveloped, the fair value is, like I've said here, 25,000, just an example. Then the cost to redevelop is 7,000. So in that case, the fair value of the asset becomes the value after the redevelopment minus the cost of the redevelopment. Now, will the entity redevelop the asset? We don't know. But we are estimating the fair value of the asset, and noting that we go with that approach. So IFRS 13 is also another centralized accounting standard that you have to make sure you understand very well, and the rules and where they are applicable, because the examiner can bring a direct question in that question 2 area for you on the IFRS 13, and you should be in the position to be able to write out the answers and apply the principles the way the principles are supposed to be applied at the end of the day. So that is the issue as well in respect of IFRS 13. So again, it is not just about the surface level things. It's the nuances that you got to pay attention to. Because the surface level stories, you can deal with them. But those nuances, these are the things that you got to be mindful of. And that is where we're going to be separating the boys from the men, the ladies from the girls at the end of the day. And that's what you have to be mindful of when it comes to the treatment of some of these standards related issues at the end of the day. Now, so if I come back, give me a sec. If I come back to my slide, you see the walkthrough for IAS 16. Now, for financial reporting students especially, we said IAS 16 is waiting for you, done deal. What are the things there, nuances that you have to be mindful of? If you ask me, the real nuances about IAS 16 will be the issue about revaluation of assets. And then number 2, the deferred tax implication when assets are revalued. Those are the nuances. So in the single entity note, especially if the examiner wants you to do statement of profit or loss and other comprehensive income, and there is revaluation of assets, then the deferred tax implication, you have to be mindful of that. We've defined or explained the revaluation issue. For the first time revaluation, and we got a surplus or we get a surplus, it goes to OCI and revaluation surplus on the face of the statement of financial position. For the first time, we got an revaluation loss, it goes to P&L account. But subsequently, whatever happens, we must reverse it in respect of the treatment we did for the first one. The excess amount is what will go to the opposite. So if the first year there was a revaluation surplus of 10,000, and the subsequent year, now there is a revaluation loss, or the asset has suffered an impairment of say 15,000, you don't say, oh, the impairment or the revaluation loss, I'm taking it directly to P&L. That would be wrong. The amount in the revaluation surplus must be written off. So you bring that 10,000 in my example into OCI, then it is the difference that will go to the P&L account. Remember also that although you may hear the words used interchangeably, there is a difference between impairment loss, that is IAS 36, another fundamental accounting standard that you must understand. Whether I like it or not, you're going to be applying the principles from IAS 36 in the exam hall, and revaluation loss. There's a difference between the two. In impairment testing, we are comparing the carrying amount of the asset against the recoverable amount. And if you remember, we said the recoverable amount of an asset or a cash generating unit is the higher of EBAZE, the net present value, and then the value in use. The value in use is discounting the future cash flows from the continuous usage of the asset using the pre-tax cost of capital. pre-tax cost of capital. So the examiner could trap you and bring you both pre-tax cash flow, post-tax cash flow, pre-tax cost of capital, post-tax cost of capital, or after-tax cost of capital. You must know that in IAS 36, when we are determining value in use, what do we use? Pre-tax cash flows, pre-tax cost of capital. So we discount that into present value. The net realizable value is what? The fair value less the cost to sell. And that will also be given. So when we get a value for that, the higher of the two becomes the recoverable amount. And if it happens that the carrying amount is greater than the recoverable amount, then we say that the cash generating unit or the asset has suffered an impairment. But if it happens that the recoverable amount is greater than the carrying amount, the asset has not suffered an impairment. The entity continues to carry it at the carrying amount. If you remember, I keep on telling you this, don't say it is revaluation surplus. Because if the recoverable amount is greater than the carrying amount, if you're not careful, you go back to auto reset, which is IAS 16, to go and say revaluation surplus. Recoverable amount is greater than carrying amount. The asset has not suffered an impairment. The asset is carried at the carrying amount. So that is the concept of impairment. Now remember, when we are dealing with a cash generating unit, which is group of assets or a business as a whole, and the business suffers an impairment, then you must remember the rules for allocation of the impairment. So the examiner can come for us in a cash generating unit environment or dedicated single item asset. If it is a cash generating unit and the cash generating unit has suffered an impairment, then we have to allocate the impairment. What did we say? Separately identified impaired asset per the question will be written off as stated in the question. Number two, if we have goodwill, because it's a cash generating unit, if there is goodwill, sometimes we may have to calculate it if it was a business that was acquired during the year. So it means your goodwill is going to be fair value of consideration minus the net asset at the date of acquisition. So we may have to calculate the goodwill. So if there is goodwill, we write off the goodwill. If after that there is still amount of impairment left, then we allocate it on pro rata basis on the remaining assets that have not suffered impairment. I am emphasizing on that last part, remaining assets that have not suffered impairment, because you see, the examiner likes to prey on students' inability to pay attention, and so they end up losing the marks. What do I mean by that? Let's say we have property, plant, and equipment. And the entire value of property, plant, and equipment is per the question, the carrying amount, it's say 400,000. Then in the question, we were told that some property, plant, and equipment with a carrying amount of 80,000 has suffered an impairment, or were involved in an accident and the entity wrote them off. So per the rule for allocation of the impairment, what did we say? We said write off separately identified impaired assets. So you will say, oh, 80,000 from the 400. So the carrying amount of the PPP after the impairment is 320,000. So when you finish that, you have written off goodwill and there is still some impairment left. But you will say, oh, PPE has suffered an impairment already. Then you will charge the remaining impairment to maybe inventory or some other vague assets that the entity may be having. But that is where you get it wrong. Why? Because the PPE, this 320 remaining, hasn't suffered an impairment. It hasn't. So if we are still left with some impairment after writing off separately identified impaired assets, writing off goodwill, then the remaining impairment must be allocated to the assets that have not suffered impairment yet. And that is the nuance that you have to be mindful of. That it is 80,000 that suffered impairment, not the whole 400,000. So the 320 asset that is left hasn't suffered an impairment yet. So if there is any impairment remaining, we must allocate it on the 320 as well. And the last golden rule that we mentioned was that after an impairment, the carrying amount of an asset cannot be below the fair value less cost to sell. Principle. Again, if you have been a good student and watched the practice question videos, especially on some of these standards, there were questions like that were in the practice question courses. What does that mean? It means that you finish allocating the impairment and an asset, maybe a property. After the impairment, now it's carried at 40,000. But the fair value less cost to sell of that asset is actually 43,000. The rule is you cannot carry an asset after an impairment below its fair value less cost to sell. So although you've allocated the impairment and now the asset is being carried at 40,000, it means you're wrong because it has to be carried at 43,000. So that the remaining amount will now be charged to other assets at the end of the day. And that is what you have to be careful there. It means we've charged more impairment to the asset than we are supposed to charge. So when it comes to the nuances of impairment also, especially in cash generating unit dealings, that golden rule is what you have to be mindful of. That after the allocation of impairment, an asset shall not be carried below its fair value less cost to sell. If you screw it up, you may do the calculation, everything, but au revoir mon ami, because you are wrong. So you got to be careful about that. That is the concept of impairment, IAS 36. So a cash generating unit, a whole business, a whole division, a whole segment of a business can suffer an impairment, or just a single asset suffering an impairment in respect of that. That's what we must understand there. Revaluation surplus or revaluation loss, on the other hand, is where we are comparing the revalued amount of the asset with the carrying value of the asset. Again, that is why I'm saying that there's a difference between revaluation loss and impairment loss. Although in principle, their treatments are the same. Because impairment loss goes to P&L, revaluation loss will also go to P&L. If there is a revaluation surplus and subsequently the asset has suffered an impairment, that impairment loss will not go to P&L directly. It will be written off in the OCI against the revaluation surplus. It is the excess that will go to P&L. So their treatments are the same. But the arrival of them, the way we arrive at impairment and revaluation loss are different. So please be careful about them. So that is the nuance there in the revaluation of assets issue that you got to be mindful of. Then the last thing about revaluation of assets is about annual transfers. Because remember, when assets are revalued, what did we say? Depreciation is going to be charged on the revalued amount. So you got to be mindful in respect of that. And then if during the year, meaning revaluation was done at the beginning of the year or midway within the year, what did we say? It means that we must calculate depreciation on the revalued amount. In that case, we may make a transfer from the revaluation surplus to the retained earnings. That is what you must understand there. So that's the first nuance on the IAS 16. Then the last nuance is IAS 12, income tax. Whether you like it or not, it is waiting for you in the exam, or especially financial reporting students. Corporate reporting students, you have no excuse about that because it is applicable in consolidation. It is applicable in dedicated standard related IFRS 2 share-based payment, deferred tax implication, as you know already. So it's a crucial area that we must understand. But here is the plot twist. If we revalue assets and there is revaluation surplus and there is deferred tax implication on that, by default, we said the deferred tax will go to OCI. That's the default treatment. And the deferred tax that goes to the OCI, if you remember, we said is the revaluation surplus figure, right? Revaluation surplus times the tax rate. That is what will go to the OCI. Very important. But again, please pay attention to the context of the question, because sometimes the examiner may say all movement in deferred taxes are recognized in the P&L. So in that case, we got no problem. It will just be taken to P&L, and then we will ignore our default rule. So the whole thing about the standards generally is what you must know. That yes, you get your principles, you know the default issues, but the context of the question is going to determine sometimes how certain things are supposed to be played. Now, if you ignore the context of the question and do what you think you are supposed to do under the default area, congratulations, you just crash yourself into something that will result to losing significant amount of marks in the exam hall. And that is the idea there about those issues. So really, when it comes to these accounting non-current asset environment, these are some nuances that I'm just dropping to let you understand. Yeah, the bare minimum issues, you can deal largely with them. At least by now, you know that in the trial balance that the examiner will give you, if you see current tax and it's on the debit side, that means that is under provision of tax. So it will increase the current tax liability. If it is on the credit side, that means that is over provision of tax. So it will reduce how much tax we charge for the year. At least you know that. No problem in respect of that. By now, you know the way you are supposed to calculate movement in deferred tax. Can it be? You know how to deal with that calculation. No problemo. Even the calculation of the taxable profit, by now, again, you are supposed to know that, because we're going to bring in the accounting profit, because sometimes the tax charge for the year will not be given, but the examiner will feed us with information to be able to calculate it ourselves. So that is the estimate of tax provision for the current year will not be given, but it will give us the data that will support us to calculate it. So we pick the accounting profit, add back depreciation, because depreciation is not supposed to be brought in that particular case. Then once you add back depreciation, you can now less the capital allowance which you calculated for, or tax allowance depreciation. And that is what gives you the taxable profit. On this taxable profit, maybe the corporate tax rate is 25%. So you apply 25% of that, and that gives you the tax payable. And that is the issue there. But remember, you would have to work for the depreciation. You would have to work for the capital allowance based on the information available. Then you calculate the tax payable at the end of the day, or the current tax provision. So those are, again, some nuances that you have to be mindful of, even when it comes to dealing with the IAS 12 environment. Again, you know how to calculate the tax base. You know the issues about carrying value, the difference between that, taxable temporary difference, deductible temporary difference. Then the final thing probably that I need to highlight there is that if there is deferred tax asset, what did we say about deferred tax asset? We said an entity must only recognize deferred tax asset up to the amount of profits they estimate to generate to be able to write off against what? The deferred tax asset. Very important. So the fact that there is a deductible amount of, say, 10 million doesn't mean all the 10 million must come under non-current assets on the face of the statement of financial position. It must be capped up to the amount of profit the entity estimates or expects to receive, then that will be the basis for how much deferred tax assets can be carried on the face of the financial statement. That is a theory question the examiner can ask you under IAS 12, but it's also a calculation related issue that you must understand. All of these nuances, again, if you have been going through things in the practice question courses, we had questions on all of these nuances that we need to go through at the end of the day. So when it comes to income tax, that's guy income tax, those are the nuances that you got to make sure you pay attention to, because especially, again, financial reporting students, whether you like it or not, you will call on IAS 12 tomorrow morning in the exam hall. You will call on it. Who pay, who pay. So you got to make sure you understand all of these aspects of the standards. And corporate reporting students, in addition to all of these nuances, the way we apply the deferred tax asset when it comes to IFRS 2 share-based payment, you got to be mindful of that. So those are some fundamental issues that we must understand when it comes to dealing with some of these standards quickly that I want to really touch on there in that particular case. Then we come to the three angels that we mentioned. That is the IFRS 9, IFRS 15, and then IFRS 16. We have emphasized repeatedly that these are standards that are frequently asked by the examiner. As you are going into the exam hall tomorrow, the examiner may get goosebumps to bring questions on these standards. For financial reporting students, it could be dedicated or part of the single entity financial statement. Same thing to corporate reporting students, dedicated or in the consolidated financial statement as part of the notes in the consolidated financial statement. So that is going to be forming part of the adjustment you must make to the consolidated financial statement when you are preparing the consolidated financial statement. Basically, when we take things like IFRS 9, we said that, permit me, let me pull up my slide on that quickly. If I can just walk you through my slide. Yes, I should be able to. We said financial asset. Financial instrument is simply any transaction where one party is recognizing an asset, the other party is recognizing equity or liability. And so we said, when it comes to financial asset, keywords that we applied here, we said either we are going to be issuing or selling. So if our entity is the one issuing or selling, then it will be either a financial liability or an equity, that is share capital. To determine whether what the entity is selling or issuing, they must recognize financial liability or equity. We said we ask ourselves our golden rule. Does the entity have an obligation to repay what they are selling? Does the entity have an obligation to buy it back? If the answer is yes, then it's a financial liability. If the answer is no, then it's an equity issue. So it will be part of share capital. Why is that important? Because you may see a note where they said, oh, the entity sold goods to Kukwa Limited for $100,000. However, the entity will buy back or has the right to buy back these goods in 2 years' time for whatever, $600,000. And the entity is going to be exercising this option. If you think you're going to apply IFRS 15 here, you toast it. Because if you check this transaction, they've sold goods, but they are under obligation to buy back the goods. So it is not a sale, but a financial arrangement. And the inventories are used as a collateral facility. What does that mean? It means the sales value, if it has been included in their sales, we're going to remove it from there. And we will recognize financial liability, being the proceeds. So the double entry to correct that error is to debit revenue and credit financial liability, because it is not a sale, it's a financial arrangement. Then on that financial liability, we will now calculate the interest from the date they made the sale up to the year ended under review, and that interest will come to P&L account and will be built up in the statement of financial position as well. But you got to be careful here, because the inventory is still with the supposed buyer. But that inventory has not been sold. So it must be included in the closing stock of our company. So although that inventory may not be in stock, the cost of the inventory must be included in the closing inventory. Now, since the entity thought they sold it, they have added it to cost of sales. So we have to remove it by crediting cost of sales and debiting inventory. This is how we treat a transaction like this. Again, these are the nuances. So we've sold goods, but we have an option to buy it back. It means it is not a sale, but a financial arrangement. Does the entity have an obligation to repay, to buy back? If the answer is yes, then whatever we are selling, whatever we are issuing is a financial liability. Very important. On the asset side of things, we said the keywords, what? Bought, purchased, acquired, invested. So when we hear things like that, bought, purchased, acquired, invested, and we are the entity, we are in the books of the entity that bought, that purchased, that acquired, that invested, then it is a financial asset. And in a simple term, we said the financial asset can be divided into two. It could be equity shares, it could be debt instrument. If it is equity shares, the way we treat it depends on the approach the entity uses. They can carry it at fair value through P&L or at fair value through OCI. If they carry it at fair value through P&L, then any transaction cost incurred in the acquisition will be written off in the P&L. Then on subsequent measurement, any fair value gain or loss will also be recognized in the P&L. But if the entity is carrying it at fair value through OCI, then the transaction cost incurred will be included, will be added in the initial measurement of the financial asset. And then on subsequent measurement, any fair value gain or loss will be recognized in the OCI. That's the idea there in respect of equity investment. But we said the entity could also buy a debt instrument, right? The entity could buy a debt instrument. If they buy a debt instrument, either it is quoted on the market, so they will carry it at fair value through P&L or at fair value through OCI, or it is not quoted, so the entity will carry it using the amortized cost method. What does that mean? It means that the issue is going to be the initial amount shall be the cost of the investment plus any transaction cost. Then on subsequent measurements, we carry it at amortized cost. But remember, it means the effective interest will come as what? Investment income or interest income. Because sometimes when you hear amortized cost, your brain will go to liability. Yes, it's a debt instrument, but the entity bought it, so it's a financial asset. That's the idea. Then finally, under financial liability, the initial measurement is the proceeds we got less any transaction cost. So in Nhyira, when do we add transaction costs? When do we subtract transaction costs? When do we write off transaction costs in the P&L? Immediately you ask that question, it means you don't understand anything about financial instrument. Because we have said, and I just repeated, based on where we are. So if you're in a financial asset, then you have to ask yourself, is it at P&L or at OCI? That will determine the way the transaction cost will be treated. If you're in financial liability, no questions asked, because transaction costs will be subtracted from the proceeds in arriving at the initial measurement. Then the final flow of these guys will be if we issue convertible loan note. As we said, in accordance with IAS 32, convertible loan note will have two components, the equity component and then the liability component. How do we get the deals? Simple. The liability component is simply the present value of the cash flows from the loan. That's all. So the annual interest, the interest on the loan, we discount that to present value, and then the redemption value. So those two items, we discount them into present value. That figure from the proceeds gives us the idea in respect of the equity. If there is any transaction cost, we allocate it between the equity and the liability amount to get our initial measurement. On subsequent measurements, the liability is carried at amortized cost. The equity remains the same. So again, when it comes to this area, IFRS 9, if the examiner is going to be dancing with you, then those are the few issues that we need to be mindful of generally at the end of the day in respect of that. That's it about that. IFRS 15, revenue from contract with customers. You know the deals there. We recognize revenue when performance obligation is satisfied. It's good. But the nuances are the various subject matter issues we spoke about. What if a customer makes payment in advance? What if we make sales on sale or return basis? What if we sell goods with pay later with a financing component in the deal? How do you do those treatments? That is where the problem about IFRS 15 is. Because if it is just, oh, au revoir, mon ami, you can work it out. But if the examiner begins to dance with you on advance payment, remember advance payments too, there are two treatments for it. Did the customer pay in advance because we gave the customer a discount? Or the customer paid in advance to secure the contract because it's part of our terms and conditions? Why is that important? If the customer paid in advance to take advantage of a discount offer, then there is a finance component in that deal. So it's more or less like the customer lent the money to us. But if the customer is supposed to make the advance payment because it is part of our policy to secure the contract, then in that case, no problemo, there is no finance cost. The deferred income will just be recognized as a deferred income, and then when we do the job, we'll remove it from the deferred income into revenue. So when it comes to IFRS 15, those are the realms that we have to be mindful of. Then the last part of that realm will be performance obligation going beyond one accounting year when you are dealing with construction contracts. You see, the reason why I am talking about the things the way I am saying them, and if you pay attention closely over the last 12 weeks throughout our session, I've been emphasizing on those things is because for the most part, the face value issues, you are okay. And 99.9% of the time, the examiner is not interested in the face value issues. He has a beautiful story in mind, so that you will see the standard there though. But the question that will be there, you may not be able to do it because it will be the nuance areas. And that is what you got to be mindful of. Then for a theory area, the 5-step framework. It can be asked as a 5-mark question as part of the 20 marks theory questions that the examiner may get goosebumps on in the exam hall that you must know about. So IFRS 15 2, those are the stories there. Very important. Then certainly you come to leases, right? How do we determine the initial measurement? The lessee can choose to use the low value approach, meaning that although they've leased it, they can treat it as normal, normal rentals. Or they can do the default approach, which is going through recognizing right of use, recognizing the lease obligation, what should be included in the initial measurement of the right of use, what should be included in the initial measurement of the lease obligation. If you remember, we've gone through stories where we said the lease liability has fixed component and variable component. Any payment that has to be made to the lessor, which is subject to meeting some performance condition, will not be included in the initial measurement, will not be included in the lease obligation. It is in the year ended, if we meet any of the conditions and we have to make that payment to the lessor, then it will be recognized as an expense in the P&L account. And the circumstances under which, if we are not giving any interest implicit in the lease, you remember the question we solved during our mock sessions. Then the normal lease question, where we have the interest implicit in the lease, the other questions we solve when we're discussing lease, and the way we work it out. So those are the nuances under leases also that you got to be mindful of. Certainly sale and lease back treatment also there. So these three key standards, you must understand them. Again, not just the face value baby issues, the nuances there that we need to understand at the end of the day. Embedded in all these will also be the concept of debt factoring. Factoring with recourse, factoring without recourse, all of those things are nuances that we must understand. Please, be careful so you don't get overwhelmed, okay? Because some of you, what I'm doing may make you panic, because you may be realizing that there are a lot of things that you probably might not have reviewed. Don't worry, you're going to be good, okay? You're going to be good. Because if you were serious, you would have reviewed it. So don't panic. Otherwise, it may affect the other things that you have already done. Okay, so don't panic. It's normal. Just slow yourself down, because that's very important for your ability to understand things. So please be measured in my discussions here, because I'm diving into things that probably you might not have reviewed yet. And for some of you, maybe this is the first time you are hearing some things, and you may start panicking. But that is why I'm saying that calm down. Don't panic. Otherwise, the things you've learned, they will also fly out in your brain. So please calm down, and I'm just trying to help you here. Okay? So just calm down. You'll be good. You'll be good. I promise you, you'll be good. So those are the issues, the nuances, the key concepts that will excite the examiner when it comes to those three standards that we mentioned, that sorry, whether I like it or not, you must know about them, because there is a high probability that they will be in the exam hall at the end of the day. Then certainly some of the other issues, I mean, IAS 33, IAS 10, IAS 8, some of the other accounting standards, you know them as well in that regard. So these are just some few key issues that I want to again rehash, some principles under the nuances on the standards that I want to draw your attention on, so that you are not just a surface, swimmer, but you are diving below the ocean and understanding the nitty-gritties of the standards. If not, you will go to the exam, or you will see that, yeah, this is the standard I'm supposed to apply. But you can't see the head from the tail of the question, because the examiner is taking you to another realm. And that is what I keep on telling you, that the ICAG examination now is not for the lay-minded person. You got to have high level of intelligence, in-depth understanding of the standards. So for instance, the thing that I mentioned about IAS 36, impairment of assets. So maybe the examiner brings a cash generating unit, and you calculated the net realizable value of all the assets individually, calculated the recoverable amount, and then you have the carrying amount of the business. So there is an impairment. You will just go ahead and use the allocation rule and start allocating. But maybe embedded in that question is that golden rule about impairment, that after impairment, an asset shall not be carried below its fair value less cost to sell. If the question was like that, and that was the mind of the examiner, that means you misapply the rule, misallocate impairment losses. At the end of the day, you are walking away with Zokbo. And that's sometimes what separates people with high depth of understanding of the standards and people who are just walking around like they are playing. So that's just what I want to draw your attention on, that be careful. You can do the surface area issues, but you got to do a suko. And that's why I taught you the way I taught you. And that's why we discussed and solved the kind of questions that we were solving. And that is where you were given the opportunity to get access to the practice questions videos as well, because it is to enlighten you on those deeper levels of the standards. And that's what you're going to face in the exam hall. And we hope you'll be able to apply the rules. So basically, these are some few key issues that we must understand when it comes to the standards. Again, this is a crucial area. We will apply it in consolidation. We will apply it dedicated question, 30 marks, corporate reporting students, 40 marks for financial reporting students. So it's a crucial area. And these are just some few things I want to draw your attention on when it comes to the accounting standards. The final thing that probably I will highlight on quickly will be, so that I can leave you to go. I don't have to hold you hostage here too long. Some of you got to sleep early so you can wake up tomorrow morning refreshed. Some of you too are not going to sleep, and tomorrow morning you're going to suffer some insomnia and things. But I pray for you that, you sleep. That's very important. Go and sleep. The last thing that I want to draw your attention, last but one, because I want to also touch on consolidation briefly, then we go. The last but one will be the ratios. Hanging fruit, easy marks area, that will be there for you. Right? So please be mindful. We've given you the principal document for the ratio analysis. This is your principal document. So that ratio analysis area, tomorrow morning you get up, make sure you go through the principle, the analysis guidelines, the styling of the question and what you are supposed to do. Understand them. That's all there is. But the only thing that I will say here is just again to remind you that the examiner will have styling of questions. Tomorrow morning, I don't know what the examiner is going to bring. Tomorrow afternoon, I don't know which of the styling, but one of these 6 sets of ratio analysis questions will be there. Your goal is to know the necessary adjustments to make. Number 2, if you're supposed to do the calculation, write the formula down, make sure you are picking the right figures. Very important. Now, the question may have its own context, contrary to what you may know. So, for instance, there may be leases in the question. Then there will be a note somewhere that, for the purpose of calculating return on capital employed, ROCE, and gearing, lease obligations should be treated as part of capital employed. What does that mean? It means when you are calculating asset turnover, you will use the normal calculation about capital employed that you know. Total asset minus current liability, or shareholders fund plus interest bearing debt, to calculate asset turnover. But when you get to ROCE and gearing, the capital employed will be the shareholders fund, interest bearing debt, and the lease obligations, both current and non-current. Again, this is where the nuances comes in. This is where we separate the people who are in debt and the other people who are just walking around. So please be careful about this area. It's an easy area. You can get a lot of marks easily. But if the examiner builds some quick stories in the notes and you misapply them, remember, if your calculation is wrong, forget about the interpretation. It's unfortunate, but forget about your interpretation because your interpretation will be wrong. So please be mindful of those nuances that we got to be mindful of. So aside the styling of the question, the way we write, we calculate the ratios, the last thing is the guiding principles when it comes to the way we write out the interpretation. If the examiner is generous to go with you on the normal approach, we said you start with profitability ratios, start with the revenue, go to cost of sales, gross profit margin, go to operating profit margin or net profit margin, then it comes to ROSI. Remember, we said there is a difference between net profit margin and operating profit margin. Although they are used interchangeably, it depends on what the examiner says you should calculate and what you use. Because operating profit margin is your profit before interest and tax divided by sales times 100. But the net profit margin is the profit after tax or profit for the year divided by sales times 100. Again, be mindful of the context. Be mindful of the context. So when it comes to ratios also, that is what I want you to be mindful of, the guiding principle. Then lastly, the pro forma structuring. If it is a report, to, from, subject matter, date, intro, conclusion, thank you, yours faithfully, signature, name. If we are just writing analysis, then we have a heading, intro, body, conclusion, thank you. But remember what we said in the conclusion paragraph. We said in the conclusion paragraph, you are going to talk about the overall performance of the entity. Then you make suggestions or recommendations of what the entity can do to fix something. Please, we don't want generic recommendations. And we've said this over and over again, right? The entity should put measures in place to make sure that they improve their liquidity position. The entity should put measures in place to make sure that it sells more goods. The entity should put measures in place to reduce the trade receivable days. In your brain, you have written something that has not been written before. But in reality, what you have written is absolutely meaningless. Put measures in place to increase sales. What kind of measures? Put measures in place to reduce trade receivable days. What kind of measures? So specific recommendations must be made. Again, don't get goosebumps. Just maybe one or two. You should be good at the end of the day. So that is also what I would want to quickly highlight to you on the easy evaluation of financial statement area that you must understand. Sometimes the examiner is faithful, which means that he will just give you the ratios, then he will say, write analysis. That kind of question is hey, it's a good thing, but you got to be careful there as well. Finally, basis of comparison. Know what to say. If it is the same entity year on year, you are at liberty. It is increasing, decreasing, rising, falling, greater, less. You are at liberty. It's the same entity. But if you are comparing the entity with industry average, you can't say the ratio has increased or reduced. You can't say the ratio has risen or fallen. You can't say, no, you have to say either higher, greater, perform better, or worse. So, because if you compare the entity with industry average, and you are dealing with the ROSI, the entity's ROSI is 20%, the industry average is 35%. Then he said, the return on capital employed has increased from 20% to 35%. This means that during the year, the entity, where Diego? You are already wrong. Okay? Anything else you write is absolute recycling bin. So be careful. Again, these are the little nuances that will make you lose the marks that you are not supposed to lose. So on top of being alert on the various issues, the little things you got to be mindful of. It's like life, right? We said the little things matter. It's the same thing in the exam hall. The little things are what will determine whether you make it or you break it. So be careful of these things. That is the idea about what I want to draw your attention to. 15 marks, or if the examiner gets goosebumps, 20, because there would then be a 4 or 5 mark question on theory. Remember, there are theories in evaluation of financial statement. Uses of the ratios, or the importance of the ratios, and then the limitations of using ratios to analyze the financial statement. Please, as part of the analysis, the examiner can embed there limitations of using the ratios. And you have to be careful, because sometimes, and we've solved a question like that before, right? The entity, we are in the books of the predator firm who is seeking to acquire another entity. And so you have to be careful that the purpose of the analysis is for acquisition. So in that kind of environment, if you are writing recommendations, you have to be careful. That is, again, another nuance that you must understand there. It's okay before I get you into various other nuances that some of you may run away from. But that is the idea. So under the ratios tomorrow, these are the 6 styling of questions. We must understand the principles underlining each of these styling of questions as we go to the exam hall. What I would say is, in addition to the various discussions we've had, in addition to the videos that you have watched under the practice questions videos, let this ratio analysis document be your guide. Because whatever styling of question the examiner brings, the way you are supposed to go about it, the way you are supposed to analyze it, is available in this document. So make sure you review it before heading into the exam hall, because that is going to play a crucial role in your ability to actually pass the examination tomorrow. Then finally is to take you to question number 1, and that is consolidated financial statement. As per our best practice guidelines, this should be your last but one question, and you are going there for the easy marks. You are going there for the calculations. We are not interested in going to extract any financial statement, because again, the examiner is not going to mark what you have written in brackets. The examiner is going to mark what is under the currency. So if the examiner comes to the financial statement you claim you have extracted and there is nothing under the currency, that is insemunu. So we are interested in doing the workings, because the workings will take 2/3 of the marks. So that is what we are interested in. So we mentioned that various issues must be understood there. First, goodwill calculation, easy peasy. In almost every consolidated financial statement question, we would have to calculate goodwill. The reason I'm using the word almost is because there are certain styling of questions where the goodwill will be given, but the fair value adjustment will not be there. So what it means then is that we have to know that when we get fair value of consideration transferred and bring the share capital and retained earnings at the date of acquisition, and then get that from the goodwill figure, the balancing figure will be fair value adjustment. So there are 2 ways fair value adjustment, or even 3 ways fair value adjustment can be embedded. The first way is the lazy approach, where the examiner says, oh, at the date of acquisition, all the plants of the subsidiary are equal to their fair value, with the exception of a plant that has a fair value above or below. That's the easy way. The second way, which is complex, is where the examiner will give you the net asset at the date of acquisition. Okay, the net asset at the date of acquisition. But then it will be different from share capital and then the retained earning at the date of acquisition, so that the balancing figure becomes the fair value adjustment. And the examiner will tell you. So you must be able to do the workings to know what the fair value adjustment is and how to subsequently treat it. The third layer of the fair value adjustment nuance is what I just spoke about, where the examiner gives you goodwill. And you can calculate your fair value of consideration transferred and the NCI. You can calculate your share capital. You can calculate your retained earnings at the date of acquisition. Then the balancing figure there becomes fair value adjustment. So you got a lot of things there that the examiner can do with you on fair value adjustment. But easy questions, goodwill calculation. Remember we said the fair value of consideration transferred, there are various components: immediate cash payments, deferred consideration, contingent consideration, share exchange, issue of loan notes. Please make sure you go over the treatment of all of these items because they are very important. Immediate cash, we don't need any issue. But deferred consideration, IAS 37, must be discounted into present value, then we unwind. So we calculate finance cost. Contingent consideration, we may discount, or the examiner will say we should ignore discounting, but any reduction in the contingent consideration is an income. You must know that. Share exchange, it is the parent who is issuing the shares, so we will multiply the number of share exchange by the share price of the parent entity. If they have not recorded it yet, then we must record it. All of those things. Then issue of loan notes, that's financial liability, IFRS 9. The initial amount will be included in fair value of consideration transferred. Then we calculate finance costs if they have not calculated it yet, and that will also be accrued to the initial measurements that will go to statement of financial position as well. So please be mindful of the treatment of each of these components. Sometimes the examiner keeps it simple, so you may hear just maybe a share exchange and immediate cash payment. Or sometimes it will just be a direct cash payment. And that's all. But you must know all the four. NCI evaluation. Either it can be valued at fair value or at proportionate method. Why is that important? Because the valuation of NCI determines how any impairment in goodwill will be treated. If NCI is valued at fair value, we said impairment will be shared between the owners of the parent entity and NCI. But if NCI is valued at a proportionate method, then any impairment in goodwill will be borne solely by the owners of the parent entity. Then fair value adjustment, the things that I've mentioned to you. Here, if the examiner wants to use your brain a lot, there could be some accounting standards that the examiner will embed there, because as always, we must revalue assets of the subsidiary at the date of acquisition. Most importantly is the issue about intragroup trading. Financial reporting students, whether I like it or not, you're going to see intragroup trading in the consolidated financial statement question. It's there. It's waiting for you. Corporate reporting student may or may not be there. It's because of the structure of your questions. Sometimes there are a lot of things that the examiner is interested in. So he knows you can deal with intergroup trading, cancel total sales, calculate PUP. He knows you can do that at this level. But he knows that you may mix it. If he brings IAS 19, employee benefit, he knows something will go through your brain if he brings IFRS 2 in the consolidated question. He knows something will happen to your brain if he brings IAS 32, convertible loan notes, under the consolidation question, because you may think that, oh, this is a console environment, so the treatment is different, but in reality, it is not. And you've seen some of those things during our mock discussion, solving those questions and opening your mind on those things. So financial reporting students, you don't have an option. Intragroup trading is there. As to whether it's sale of goods or transfer of assets, that one, it is in your hand. Corporate reporting student may or may not be there, but the examiner expects you to know, so you have to know it, right? Remember we said we are dealing with a post-acquisition sales. So any post-acquisition sales, when we are preparing consolidated P&L, cancel it out from the sales, from cost of sales. Then goods that are remaining at the end of the year that the buyer has not sold yet, what happens? We calculate PUP on it in that case. If they transferred assets on a consolidated environment, there is nothing like transfer of assets. So you remember we solved a question and we said under IAS 40, where the parent has rented out a property to a subsidiary. What did we say? We said in the individual books of the parent, they can treat that as an investment property. But in the consolidated financial statement, that is not an investment property because you treat it as what? IAS 16, property, plant, and equipment. So if there is transfer of assets, if the parent was the one who sold the assets to the subsidiary, whatever profit or loss the parent earned on the transfer must be reversed from the parent's book. That means that from the consolidated perspective, in my example here, the subsidiary may have charged more or less depreciation than they are supposed to charge. Let me use numbers to illustrate what I'm talking to you about. Let's say that the carrying value of the asset was 10,000. And then the sales value of the asset was 12,000. What does that mean? It means provision for unrealized profit. The parent who sold, in my example, parent is selling to subsidiary, pocketed a profit of what? 2,000. What we are saying here is that this profit that the parent made, you can't sell between yourself like that. So this profit of 2,000 must be reversed in the books of the parent. So what will be the journal entry? The journal entry is simple. Because it is profit, we're going to debit group retained earnings, okay? And then credit PPE. Because it means the asset has been overstated. So this is the provision for unrealized profit. And this is happening in the books of the parent. Then we go to the books of the subsidiary. The subsidiary has charged depreciation, but from consolidated perspective, the subsidiary has charged more depreciation than they are supposed to have charged from the consolidated environment. Agreed? Because their initial measurement will be what? The 12,000 figure. So the subsidiary will charge more depreciation than they are supposed to have charged for consolidation purposes. So any excess depreciation that they are charging above the carrying amount will be reversed also in the books of the subsidiary. So in this case, we will going to be debiting PPE because there was a gain, they charge more depreciation than they are supposed to have charged. So the excess depreciation will be added back to PPE. Then we'll credit, meaning add it back to the profit for the year of the subsidiary. That is the idea about transfers of assets. If it was a loss, the reverse of everything I've done is true. So we would have in the parent's book, we would debit PPE, credit group retained earnings. Then in the subsidiary's book, we would have debited their profit, subtracted from the profit, and then credited PPE. So that's the idea about transfers of assets. If the examiner is interested, he could make you do that as well, because that is part of the intra-group trading. Lastly, nobody is supposed to owe anybody. So any current account outstanding, payables, receivables, in the books of everyone, if we are doing consolidated position, we must cancel it out at the end of the day. Then finally, the issue about investment in associates. We said we apply equity accounting. And so if you remember the pro forma that we brought in when we're doing consolidated financial statement, so this was the pro forma we brought in when we're doing consolidated financial statement. So investment in associate. So we bring in what? The cost of the investment, post-acquisition profit or loss adjusted, impairment in the investment in the associate adjusted, if there was a sale between the parent and the associate, or between the parents and the associate, and it has not been sold yet, goose, provision for unrealized profit will be calculated. But be mindful, in the associate, we will only take the parent's share of the associate of the PUP. That was a key thing we highlighted very well. Then any dividend we receive from the associate will be subtracted. Remember, we said when you go to consolidated P&L, it is the profit or loss from the associate that comes in the consolidated P&L, not the dividend we've received from the associate. Again, these are some nuances you must understand. So if they received dividend during the year and they had included the dividend in the investment income in the individual books of the parent, when we are preparing the consolidated P&L, we would deduct the dividend from the investment income and bring a line item, share of post-acquisition profit or loss for the year from the associate, because it is post-acquisition profit or loss that comes in the P&L account. So where does the dividend go, you are asking? Group retained earnings. If we are supposed to prepare consolidated position, group retained earnings will come. We bring in share of profit or loss. That means we made a profit during the year, so we add it. Then the dividend received will be subtracted. So the net figure is what is going into the group retained earnings. Please note, it depends on the type of consolidated financial statement we are preparing and the workings you must do. If the examiner asks you to prepare consolidated P&L for 20 marks, that's what we are doing. Okay. Consolidated profit or loss. Then you don't need to calculate non-controlling interest, because we don't need carrying amount of non-controlling interest. Then you don't need to calculate group retained earnings, because we don't need that. We don't need that. Then you don't need to deal with any current assets, current account balances, because you don't need it. So you have to be careful so you don't waste time to do something that you end up realizing that, oh, I didn't need this. And that will be really, 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 really an unwise use of your limited time in the exam hall. So please know the requirements of the question and what you are to do as part of the workings, then you go away in that particular case. So these are also some few things that we must understand. Certainly, corporate reporting students, you know, those various nuances that we need to know about: foreign subsidiaries, disposals and acquisitions, stage acquisition, and those other issues that we must understand relatively or specifically in corporate reporting. Those are the things that we must know about there in that case. So that is the idea about some of the things that I want to bring to your attention. Certainly the 20 marks theory area, I've shared some thoughts on some of them. Again, in the book, in the document that we shared with you, which everybody has, you will see the summary of all of the key theories that we discussed. So please go through them, because they are going to be there in the exam hall. Okay, the theories on console, the theories on ethics, the theories on governance, the theories on what else? Conceptual framework. Then what I asked you to read on the IFRS foundation, please make sure you read on that. Stages involved in the setting of accounting standards, and then the roles of the various bodies involved in the accounting standard setting: the IFRS Interpretation Committee, the IFRS Advisory Council, the International Accounting Standard Board, and then the IFRS Foundation itself. Because the examiner can ask you about their roles as part of that theory area that you must understand. So please make sure you go through all of those things in that particular case. And I think I'm going to be wrapping up around here today for our discussion. Got to let you go sleep and wake up tomorrow morning refreshed, so you can go into the exam hall well prepared for the examination, generally at the end of the day. But those are the things that you must understand or be mindful of when it comes to dealing with your financial reporting or corporate reporting examination. So that's all there is for our examination. I think let me highlight this, the last one, then we go, just a few minutes. Remember we said your presentation. I think I mentioned this already. Then we spoke about the pressure in the exam hall, right? So please, I beg you, follow the instructions of what I have told you. Tomorrow, when you get to the exam hall, I don't care what comes on your head. When you get to the exam hall, take your time. Read through all the questions and answer the written questions you can do best first. It's 20 marks. Take them out quickly. Then go to the ratios. It's going to be easy if you're a good student. Then you can go to the standard, single entity FR, specialized transaction, standards, CR. So by the time you are approaching consolidation, which is going to take life out of you, at least you have approached 80% of the areas and you are going there for the easy marks. But as I say always, it's a best practice. So if you get to the exam hall and you feel, oh, the consolidation question, that's what you can do, you can start with, I pray for you. Okay? I really, really pray for you, because you're going to fail the exam. You will fail the exam. If you attempt that strategy, your probability of passing is going to be very low, because consolidation is always going to demand more time than the time required. And then you will now be under pressure to rather do the ones that are easy areas, like the theories, like the interpretation of financial statement. So it's about strategies. It's about approaches. So please be mindful of that in that particular case. All right. So that is what I would say there. If there are any other specific questions for me, probably you can bring it up and then I can answer that quickly before we sign off. What do I have here? Abubakar, thank you. My question is concerning IFRS 18. What do you need IFRS 18 for? IFRS 18 is going to be effective in 2027. That's the effective date. Yes, early adoption is available, though. You can read that. Maybe I don't expect the examiner to ask you questions about IFRS 18. It's going to be effective in 2027. All right. Yeah, it's under current issues. It's the new accounting standard that is coming to replace IAS 21. Okay. Let me say IAS 21. IAS 1, presentation of financial statement. You can read it. I mean, it's not something I expect the examiner to ask you about. Its effectiveness is 2027. So we are far from it being a subject matter of headache. If you have headache, use that headache for something else. I'm not saying this thing is going to be in 2027. If anything, if you're in practice, yeah, you can learn it ahead of time because early adoption is available or acceptable. But in the ICA scheme of things, there are no early application in the questions before the standards become effective. That's the structure. In ACCA, yes, sometimes you will see questions on standards that are yet to be effective because of early adoption. So that's what I would say there in that regard. Then kindly brief us on any treatment of any item on the consolidated statement of changes in equity. When you say treatment of any item, what exactly do you mean? Because the consolidated statement of changes in equity is the same as the statement of changes in equity. We'll bring the parent share capital. If there was any share exchange during the fair value of consideration transferred and it has not been recorded, then we'll record it, issue of shares, so that share premium will also come in there in the statement of changes in equity. Then the profit for the year for the parent and the share of profits from the associate or subsidiary will also come there. If during the year the parent paid any dividend, then the dividend will be paid from the retained earnings, and you get your closing figure at the end of the day. So there is nothing peculiar or special about the consolidated statement of changes in equity. If you know the issues about statement of changes in equity for single entity financial statement, it's the same ideology that we are applying in the consolidated environment, except that, as I said, if there is share exchange and it has not been recorded, then we will record it as we know already. Share of profit from the associate, share of profit from the subsidiary, profit for the year of the parent entity itself, all that will be added to the opening balance of the retained earnings. If the parent paid any dividend, it will be deducted as well. Then you get your closing figure, which will then be carried to the consolidated statement of financial position. So there's nothing special about consolidated changes in equity. The same ideologies as you know already. What else do I have? Let me see. Exactly. Panic is setting in. I think I have addressed that. If you're panicking because of this presentation that I did, then you have a problem. But as I said, don't panic. Okay, whatever you've done, it's okay. After this session, when you log off, go and sleep. Okay, I promise you, sleep. It's gonna help you mentally. Sleep. Okay, and wake up tomorrow morning. Have a good breakfast. Chauffeur or drive early. Get to the exam hall, and then do something small. You're gonna be okay. Okay, because if you're not careful, you will now be jumping. Hey, listen to what Nhyira said. Hey, then you're gonna lose your grounds. So it's okay if there are things that I mentioned that you realize that you don't even know about them, like IFRS 15, the nuances I mentioned, IFRS 9, the nuances I mentioned, IFRS 16, the nuances, then the various other standards, income tax, the nuances. This is not the time you will say, hey, nah, about tobo. It will more trishy, okay? Relax. It's okay. You're going to be good. You're going to be good. I promise you. Whatever you've done so far should help you to do something in the exam hall. So don't panic, because it's not a good thing. If you panic, it affects everything else. So just learn to calm down. You're going to be okay. All other things being equal. Then I'm seeing a chart coming up from here. Please, I need a brief recap of how to get the intrinsic value in the deferred tax effect in IFRS 2. Yeah, we said the intrinsic value is the difference between the share price at the exercise date and then the value of the share price at the grant date. That is the intrinsic value. If we are supposed to calculate it, that is how we calculate it. So at the exercise date, what's the share price? Then at the grant date, when the announcement was made, what's the share price? The difference between that will be the intrinsic value. But in most cases, the examiner will present us the intrinsic value, so we don't have to calculate it. But if we are supposed to calculate it, it's the difference between the value at the exercise date and the value at the grant date, because that will be the profit, if you want, that the employees are going to be getting. And so it is on that profit that we can get the tax deduction on. Does that make sense, Daniel? That's the idea about the intrinsic value. Nathaniel, well done, sir. I have understood the standard you explained. That's great to hear. What else do I have? Derek, NCI attributable to profit. Do we subtract extra depreciation. Oh my goodness. You know why I'm laughing? It's not funny, but I'm laughing because it, if you are asking a question like this, there is a fundamental problem about how the post-acquisition profit or loss calculation has to be made, Daniel. Because you see, the post-acquisition profit or loss calculation, it goes like this. We bring the post-acquisition profit or loss for the year. So let's say it's a full year. So you take the subsidiary's profit and then you bring it. If the subsidiary sold goods to the parent, or the subsidiary sold assets to the parent, then PUP workflow will come. If there was any fair value adjustment issue, which means that we have to calculate additional depreciation or excess depreciation, that will also be adjusted for. So the fair value adjustment could be positive or negative in that case. Then if there is an impairment in goodwill, so your depreciation issue, probably it will be here. Okay? Your depreciation. Now, when you say, is it subtracted or added, it means, that's why I said there is a fundamental problem there. There is no rule about subtract or add. It depends on what is the fair value adjustment situation. If the fair value of the asset is exceeding the carrying amount, then the subsidiary had understated their asset. So in that case, we calculate additional depreciation, then it will be subtracted from this area. If the fair value is below the carrying amount, then the subsidiary had overstated their assets. So they have charged more depreciation than they are supposed to have charged. So the excess depreciation will be subtracted here. So that's why I said, like your statement, there is a fundamental problem that we have to fix, which is your understanding of the way. So it depends on the context of the question. It's not about do you add or you subtract. The context is the explanation that I gave you that you have to be mindful of. Then fair value adjustment. Then if there was impairment in goodwill and NCI is valued at fair value, that's going to be subtracted. Then this can be your post-acquisition profit or loss, which is what you will share between NCI and CI. But here is the deal. This post-acquisition profit or loss, maybe we have acquired a business 2 years ago. So the post-acquisition period is 2 years. If we have to deal, if the examiner is asking us to prepare consolidated profit or loss, and we are looking at the profit attributable to owners of the parent and then NCI, the share of NCI profit you are bringing here is for the current year ended under review, not the whole 3 years post-acquisition period. That's another nuance there. So that is why I said the spirit of your question indicates fundamental issues, right? Because if your foundations are strong, then that question wouldn't be a question or a problem. So those are the nuances that you must understand in respect of that. So you don't just take this post-acquisition profit figure, and post-acquisition is 2 years, and you come and say, oh, share of NCI, you take that figure and bring NCI percentage to share the profit for the year. Then the profit attributable to NCI will be wrong. The profit attributable to the owners of the company will also be wrong. So it means that part of your consolidated P&L is au revoir, mon ami. So that is the nuance there to address the way your statement is. So it depends on the context of the question and what we have to do based on depreciation and based on NCI attributable profit. It all depends on the context of the question. So if your foundations are good and you are strong in consolidation, then you will know how to deal with the NCI attributable, profit attributable to the NCI. Then again, you will know how to handle any fair value depreciation. because it will depend on the context of the question. That's the idea there. All right, so I think that is all in respect of that. Okay, thank you. All right. So I think that will be all in respect of that. Have I addressed all questions? Yeah. So that's it about that. I'm going to end here today. So please, as I've said, do what you need to do. Go over the theories again tomorrow morning. Go over the principles in respect of evaluation of financial statement. Corporate reporting students, go over the guiding principle on business valuation. The core principles you must understand. Go over them. Go over the core principles you must understand when it comes to financial reconstruction. Because the law is the law is the law. In the exam hall, all you are doing is application. So you must know your rules. So go over them. So if I were you, after this, go and sleep. Bath, sleep. Okay? Sleep. Have peace of mind, sleep. Tomorrow morning, you get up, freshen up, then you can do the things I'm asking you to do. You glance through the theory 20 marks area again. You go through the ratio analysis document, look at the things there again. Then you come to the issue in respect of corporate reporting student, the business valuation general principle, the specialized financial reconstruction, the principles we discussed. Then the standards, any of the nuances that I went through with you that you want to look at. So it's a cruising period. Jenny Pako Bafe, hey, Ben Midnight Candle, hey, Midnight Cry, hey, Midnight Wape, hey, Midnight Mommy. Ebe how wadrin. That's why some of you, maybe tomorrow when you finish writing the exam, you will get home and it will be like you carried the world. Why? Because instead of learning over the 12 weeks, you are coming to study. But it's too late. It's too late. So just sleep. You'll be good. So make sure you get a good rest. Relax. Because your brain needs that to be able to remember the things in the exam hall. And as I said, when you get to the exam hall, please learn to calm down. Okay? You can, make sure you have water with you at least, so that when you get to the exam hall, just calm down. When you panic, nothing works in your head. So whatever be the case, please learn to calm down. Okay? And I told you, if you start panicking, you got 10 seconds to kill that spirit. 10 seconds. Don't allow it to germinate, grow, and take root. So you got 10 seconds. And please, just calm down. If you can calm down in that 3 hours, well, your brain will be sound. You can move with speed and accuracy. And you can answer the questions well. But how do you reduce the probability of your panic levels? By going through the questions in the manner that you have been guided. Answer the theories first, 20 marks. Come to ratios, easy peasy. Go to a specialized transaction, corporate reporting students, then the standards. Financial reporting student, the standards question 2, single entity financial statement question 3. They are all standards anyways. Go there. So by the time you are coming to console, you are coming for some easy marks at the end of the day. This is the best practice to reduce anxiety and pressure. All right? There is no demon after you. Okay? There is no demon. Respectfully, you've not reached the level to have the devil's attention. Okay? You are just doing yourself. So let's Satan rest. All right? You are a Christian. Most of you are. God has given you the spirit of power, love, and sound mind. The devil doesn't have your GPS. Okay? He doesn't even know you exist. Respectfully. It doesn't matter how you think you are, but there's nothing after you. Okay? Don't give room for negative energy. I told you this yesterday and on Friday. Stay positive and command your morning, command your environment, command your society, command the things that are going on with you. That means you got to guard your mind very well. If you can do that with all the discussions, I think you should be able to go to the exam and pass the examination. All right, so that's it. So please, freshen up. Nada. I know you own that. Okay, some of you, you've bought coffee, Nescoffee like one bag. I think I'll be no coffee. And come and learn, they'll be doing. Why? Oh, Charlie. Go and sleep, okay? Go and sleep. If there's anything you have, I'll be on standby. So I'll be on standby because I'll be available. So if there's anything you have, you can ping me. If I'm not asleep yet, then I could answer for you generally in that regard. But hey, if you have anything you want to pick my brain on before the exam, certainly during the exam you can't reach me, and don't try. So during the exam you can't reach me. So, but before the exam you can reach me, and then I will be able to assist you generally. Okay. But immediately the exam starts, that is all. There was a time someone sent me a message from the exam hall. Very, very. Look at me. Then my face will be on in front of graphic. Gentleman, aiding and abetting student. Immediately I got a message, no. Took screenshot, back, forwarded the student details and everything, fed to ICA. What do you mean by to? Oh, I will let you be jailed first and your life be damaged first before you damage my own. My reputation is key. So before the exam, you can reach me, but don't try anything, okay? Just learn. You'll be good. Don't go and do any stealing. At your age, now you're say to apply. The nice boy, then you see your face in front of graphic. ICA student banned from writing ICA for 5 years for examination malpractices. Look at the disgrace you've brought on yourself because you didn't learn. So please relax. You'll be good. Okay, I promise you. So wishing you all the best and praying that the efforts that we have put in will yield fruitful results and outcome at the end of the day. But the most important thing is I need you to relax. That's very important. And God be with you. We'll see you some other time in another subject, not in this subject. Au revoir. Bye-bye. Why? I'll send it.